Ladies and gentlemen, welcome back to the channel. Today, Tesla stock, did not have a great day. Now, the top of mind question of all of you guys is most likely, what's coming next for Tesla? Does this mean Tesla stock is going to sell off into the robotaxi event? Does this mean we have a greater chance of going higher following the robotaxi event? In my opinion, I will share with you what is coming next for Tesla stock. Now, unfortunately, October is not a great month for markets historically, and it seems like this time around there's more uncertainty out there. And as I've said before here on this channel, markets are exceptionally good at handling bad news. They're really bad at handling uncertainty, because the top of mind question for everyone when there's uncertainty is, how bad is this going to be? Is this going to be not a big deal, or could this spiral into something much larger? We have the port strike going on right now, which could be a nothing event, or it could be a black swan event that shuts down a lot of activity in this country. On the other hand, you have this Middle East situation, which could be a nothing situation. Nothing could spiral further. Things could go back to kind of how we were the last month or two, where there's some regional conflicts, some here or there problems, but it does not spiral into an all-out war. Or it could spiral into something that looks like World War III. There's a lot of uncertainty, and the spectrum of potential outcomes is large for both the strike, the port strike, and for the Middle East conflict. At the same time, we are weeks away from an election, which is going to have financial impacts from both sides. No matter if you're looking at Kamala and the Democrats, and they're talking about raising the corporate tax rate and taxing people more, it's not exactly good for markets. And Goldman Sachs has put an estimate out that 5% of EPS for 2025 could be impacted based on a higher corporate tax rate alone. Okay, fine. Trump's tariff policy of enacting a 20% global tariff on goods entering into the US is also going to have financial impacts. Now, those financial impacts may not affect EPS as much, because most companies that do business in the US that are incorporated in the US are, going to try to manufacture as much as they can in the US, but there is definitely varying consequences for different companies that do some of their manufacturing overseas and ship those products to the US. I can think of like food companies that may develop food in other countries and ship that to the US. Pepsi, car companies. There can be a lot of different industries that are affected from that. What's better? What's worse? I don't know. But as we get closer to the election, throughout probably the second half of October, let's be honest, you are probably going to see more uncertainty around the election. And yeah, that's probably going to start negatively impacting the markets as well. So really, in a nutshell, you have all three of these major events that on a scale of uncertainty could be nothing events, or could be really, really bad events, and we don't have any clarity on what's going to happen. As these issues do progress, you're likely to see them weigh more on our markets. The problem with this is our markets are not priced for this. The markets are expecting 20% EPS growth in 2025 just to meet estimates. That's like what we're priced for right now. If we were to come in less than that, that's a big problem. Even if we meet those expectations, there's not that much upside in markets, because expectations are already so high. It's kind of like if Nvidia rallies into earnings 50%, odds are the thing's going to sell off after earnings, and we've seen that last earnings. Or for Tesla, let's say Tesla rallies into deliveries, which it did, and then deliveries come in line with expectations, and the stock still sells off 3.5%. Okay, think about that concept on the larger scale of markets. Markets are rallying into 2025 because we think it's going to be a good year. Even if it's a good year, that likely doesn't provide further upside for equities. Now, if it's a bad year, then you'll be surprised at the downside, right? And there's even going to be more uncertainty around that. I think the question will start to come up more. Are markets priced for perfection? And is that realistic? Now, we have some people like Tom Lee that just came out today and revised his end of year 2025 price target for the S&P up to 600. This is for the SPY, 6,000 on the SPX. That's only 5.5% upside. You can almost get that in a 6-month treasury bond. Like, what's the point of going long markets here if the upside's 5.5%, but you can get almost, 4.5% or a little bit more in 3-month treasury bills, which covers the end of this year anyways. There's not a huge reason to be super bullish in markets right now. And I do find that somewhat problematic for Tesla stock, because at the same time you have all of these events going on. You have Tesla that's down 40% from all-time. We're finally getting these rate cuts from the Fed. Tesla started to get some momentum recently. You've started to see shorts covering on short positions. You've seen almost 30 million shares that have been covered in the last couple of weeks on Tesla, really the last 8 weeks or so, call it the last 2 months. Lots of shorts covering. Option activity has really picked up as well in the past 2 weeks or so. And people seem to be more bullish on Tesla now than they have been in a long time. And as we head into the robo-taxi event, I think there is room for upside. I think there's a lot of room for upside, especially, as I've said before, if we get guidance for the robo-taxi network in 2025. Whether it's the first half or the second half of the year, it doesn't really matter. We just want guidance on the robo-taxi event. We preferably don't want guidance for 2026. We want guidance for some point in 2025. That is a big upside catalyst as well. And I think a lot of people have even forgotten about the lower priced Tesla vehicles that are expected to start production in 2025 also. And I think that can be a positive catalyst for Tesla stock, not to mention Tesla's AI capabilities. So there's a lot of reasons to be excited on Tesla. And again, I've said this as well in other videos. At some point over the next couple of months, the attention will change from GPU providers, from the enablers of AI, to the appliers of AI, the companies that are actually applying AI to real life services or products. Those are the companies that I think will start to garner most of the attention. And when I think about different AI products and what's going to be impacting people's lives the most, by far it's Tesla. Now, there can be some AI adjacent plays in healthcare. I think that could be bigger than full self-driving, like gene editing long term. But in the foreseeable future, the best, I guess, gamble, if you will, is Tesla's going to solve FSD and the robotaxi network is going to be massively successful. Give it enough time. And now that rates are falling, investors are starting to broaden their time horizon. And I think you'll get a lot more hype, excitement, momentum in Tesla and really other AI appliers as well. These are going to be software stocks. You can include some of those in there. That's partly why Palantir, I think, has done very well as of, the last couple of months. They're applying AI and actually seeing results from that. Tesla's moment to see results will come a little bit later, but I think the same concept applies. Now, I guess I forgot to mention probably the biggest uncertainty of all is really the economy. Now, Wall Street and Main Street have different views. Wall Street is dead set on a soft landing, and there's really nothing that the economic data could tell Wall Street at this point that we're going to get anything besides a soft landing. Wall Street is dead set on that soft landing narrative, and that's why markets are where they are, and to be quite frank, unprepared for downside or a weakening economy. The problem is, if we start to get data that does look weaker, then we could have material downside from here. And there's a big discrepancy between Wall Street saying everything's fine, the economic data that may or may not be a little on the rig side that says things are okay. At the same time, Main Street is saying something totally different. Take a look at this post that I shared from my Facebook account, my personal Facebook account, and that I want to share with you guys. This post says, as a rapid rapid job quitter. I'm telling y'all right now, this is not a quitting economy. I've seen multiple different posts like this, some on X from just random people not in markets. And I've seen this on Facebook a couple of times, and people that I actually know in real life trying to find jobs that are having a very hard time doing so. But yet the JOLTS job openings show that there is plenty of jobs out there to be filled. The reality of the situation is there's not. From what I'm seeing, what I'm hearing, people I'm talking to, people I know, it's pretty hard to find a job right now. Or maybe people are being a little on the picky side. Okay, maybe they don't want to work all these minimum wage, lower end jobs. But there is a problem going on that's not being reflected in our economic data. And I think the bigger risk is the data is delayed and or inaccurate. And I do think as time goes on, we will see that data start to reflect what you're seeing and hearing in the actual economy, which is a much weaker picture. I mean, consider this. David Rosenberg, as I shared in the last video, says that if you don't seasonally adjust the ADP employment numbers for the data that we got this morning, ADP employment actually plunged negative 260,000 jobs, which was an unprecedented decline for any September since the series began in 2010. Yeah, that is kind of fishy because usually starting in September, you tend to see that seasonal hiring actually pick up. But we really didn't see that if you don't factor in those seasonal adjustments, which those seasonal adjustments tend to be positive, right, during this month because of that seasonal hiring you normally see. Now, what's actually interesting is we get data coming out tomorrow. The Challenger job cuts. Now, this is basically like warn notices, like you're about to get unemployed notices, the job cuts, okay? Now, what you tend to see is a spike in January, February, and March of any given year because, the job cuts are low during the holiday season, right? They're really low in September normally and usually trend at a low level throughout the remainder of the year. Well, what you seen last month was over 175% increase in month over month Challenger job cuts. Now, what's most interesting is we're actually expecting the September number tomorrow morning, and that's really the biggest piece of data we get tomorrow, to come in at 79,000. You were only at about 76,000 last month. So you're actually expecting more job cuts, more unemployment notices to have went out during this time of the year would be a problem. So be on the lookout for that data coming tomorrow. Initial jobless claims are expected at 220,000. Last week it was 218,000. Any big move higher there is definitely going to catch market's attention. But I think the services PMI is going to be a little bit more important. We're expecting 51.7 for the headline number. Last month was 51.5. So you're expecting a little bit of strength, I guess, in the services sector. Anything below 50 is contraction. Anything above 50 is positive. So it's supposed to get a little bit better. But you are going to get ISM services business activity, employment, new orders, and prices paid. I think employment's going to be a big component there. You're almost negative for service employment. New orders is also important. You're expecting that's going to fall about 1 point. Prices are expected to actually rise a little bit, which is interesting. And business activity is also expected to decline. So it's going to be the estimates are pretty similar to last month. But if you get any outsized moves, especially in the employment sector of this ISM services PMI, that's going to really spook markets. Because we already have manufacturing that's been bad for a long time. For like 2 years, you've been in a manufacturing recession. If you start to get services that look like they're heading towards recession or going negative, that's a problem. That's going to set us up for Friday's non-farm payrolls, expecting 140,000 job ads. Anything higher than that's going to be good news. Anything lower than that's going to be bad news. It's pretty straightforward. The unemployment rate is expected to remain stable at 4.2%. And again, any move higher there is bad, and any move lower is good. So really, with this uncertainty around the economy, it doesn't seem like we're getting the most accurate data. And it's just my opinion that you will start to see more accurate data reflecting what we're seeing in the actual economy now over, the next coming months. I mean, I find it very interesting that top of mind for, let's say, voters this year is the economy. And everyone says the economy is so bad and this and that. But if you look at the government data, it doesn't look bad at all. It looks like the opposite. It looks like the economy is booming, right? There is a massive disparity between what Wall Street is seeing and what Main Street is feeling. And I do think that convergence from the divergence that we have now, the gap that we have going, closer together, that convergence is going to be painful for markets. Now, whether that happens in October, November, I don't know. I'm more concerned about December, January, February, March of 2025. I think if we get to March of 2025 and things are looking better in the economy after the election, the data maybe is more reflective of what's going on in the economy, then I think 2025 could be a good year after all. I think that would probably be the point where I would feel confident to say maybe we actually did achieve a soft landing. But people calling for a soft landing this premature has me a little concerned. I mean, just look at this for an example. Yardini says the U.S. economy is roaring. Last week's revisions blew away the hard landing scenario. Productivity growth will be revised higher and unit labor cost inflation will be revised lower. There has been no landing and certainly no hard landing. I mean, look at Goldman Sachs. Goldman Sachs trading desk from Rubner says, quote, I am bullish on U.S. equities for a year-end rally starting on October 28th. I am worried that my 6,000 target is too low. I mean, with markets priced for perfection, we're really concerned about 5.5% additional upside targets being too low? Like, are we expecting an even larger bubble here? Because that's the kind of territory we're starting to get into. This is problematic. This is the opposite of what sound investors do. When things get overextended, like Warren Buffett has done, you raise cash. I mean, it's more important when you buy a stock than when you sell a stock. You make money when you buy a stock. If you buy a stock at the right price, you'll make money. If you buy a stock at the wrong price, you will lose money. And it doesn't matter if you sell it 1 second later. It doesn't matter if you sell it 10 years later. If you bought a stock at a bad price, you're going to lose money. If you bought a stock at a good price, you're going to make money. Even if it's not as much as you thought, as long as you bought it at a good price, you're going to make money, whether it's 1 year or 10 years down the line. This feels like a moment where people are so consensus bullish. Like, it seems like the easiest thing to do right now is be consensus bearish. Now, specifically, what do I think about Tesla stock? Now, I do think there's going to be more volatility heading into the election. I do think we should mentally prepare ourselves for a bit of a sell-off, but you have kind of seen that over the last 2 days. Tesla stock is down about 6% from the highs that we, again, just seen about 2 or 3 days ago. I think you're better prepared, heading into October 10th, meaning that if Tesla stays around current levels heading into October 10th, you could actually see a rally upon Tesla stock. And the lower Tesla goes between now and October 10th, then I do think the higher Tesla will rally after October 10th, because I think we're going to get good news and generally be pleased with the October 10th robotaxi event. Now, it's hard to say what's going to happen in markets over the next 8 days or so. I mean, that's a very, very short-term call. I don't know what Israel's plans are, okay, if they plan to retaliate very soon, which looks like it could be the case. It's being reported today Iran just shut down their airports. So perhaps that happens over the next coming hours or the next coming few days. I think that's going to drive more, selling pressure in markets. I do think the jobs numbers on Friday are probably going to come in pretty good, and that's going to help support markets. So from that standpoint, if we exclude geopolitical tensions, then I think Tesla probably rallies into the October 10th event after, of course, today's 3% reset or so. If things get worse in the Middle East, and maybe the data is not as strong as we think, Tesla's going to sell off heading into the October 10th event. But really, when it comes down to it, you want to just think to yourself, is the economy going to be better or worse than it is today 6 months from now? If you think it's going to be better than where it is today, then you want to be buying Tesla stock. You want to be buying markets. If you think the economy is going to be worse off in 6 months, maybe it's time to hold tight and save as much cash as possible. I can't say with any degree of certainty the economy is going to be stronger 6 months into the future than it is now. I just can't say that with any degree of certainty. I don't think there's anything that really suggests that based on what I'm hearing and seeing on Main Street. Again, not Wall Street's data, Main Street's data. How are people feeling? How are they doing? How's debt look like? What's auto delinquencies look like? What's consumer spending activities look like? None of these things give me optimism that we're going to even meet nor exceed the already high expectations that Wall Street has on Main Street. So hopefully that makes some sense. But I do think if we get a soft landing in the end, areas that are going to do well are Tesla, small caps, mid caps, interest rate sensitives, cyclicals. And I think that area does look pretty reasonably priced. If you look at Nike, look at Humana, look at Dollar General, look at Tesla, look at some of these stocks that are almost like fallen angels that have fallen, 60+%, some of those 50-60% from all-time highs. I mean, those offer a pretty attractive risk to reward. If things get better in the economy, those stocks can do very well. They're not going anywhere. So if the economy does well, those stocks will do very well. Tesla, again, included. If the economy does poorly and we slow down further or enter a recession, they're much better priced for that than the headline S&P or big tech for that matter. So I think there's areas to invest in this market. I think there's areas that make sense to invest in this market. But if you want to be in big tech, if you want to be in tech in general, it's probably not the best time. Just my opinion. And again, a lot of people think rate cuts are good for markets. Historically, when the Fed cuts rates is when you actually want to get out of markets. So you got to be a little bit careful of some of the commentary you hear from Wall Street, because they're going to tell you Fed's cutting rates. Don't fight the Fed. Be in markets. In fact, you're actually fighting the Fed if you're in markets right now or super bullish on markets. I'm almost fully invested in markets. But you're kind of fighting the Fed, because historically when the Fed cuts rates is when you want to be out of markets. When the Fed is historically raising rates, you want to be in markets, because that means the economy is doing well. 2022 was a bit of an exception to that rule. But with the rambling, let's go ahead and wrap this up. I do think Tesla has a good shot of rallying into October 10th. Now, would I go all in on that bet? No, because there's so many other different variables and factors that I can't account for. I don't think the election is going to be much of a problem for markets in the near term. I don't think the economic data is going to be much of a problem for the markets in the near term. In fact, that can actually boost markets, because I think we're getting baloney numbers, if we just want to put it just blatantly. And I think those baloney numbers are going to be good. What happens in the Middle East and how does that affect our markets? I think that's a bigger question over the next couple of days. As long as nothing escalates, I think markets, Tesla specifically, may be able to do pretty well heading into October 10th. But after October 10th, I'm a little bit more optimistic on Tesla until we get this election correction. So I wish I could provide more clarity on exactly what's coming next for Tesla. If you believe in Tesla long term, I don't think these prices are bad at all. But it really comes down to what is going on in the economy 6 months from now. Is the economy better than it is today 6 months from now, or is it worse 6 months from now than it is today? That's really going to dictate where markets go really over the next couple of months. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.